After you identify a very good setup and you enter the trade, the market doesn't go your way. What will you do? Will you panic or will you hold the position? So basically, after you enter the position, there could be three scenarios here. The first one is, as expected, the market will go your way and you take your profit as planned. That is the best result. The second scenario is the market is consolidating, even though it is not going your way right away. So this time, you want to ask yourself, is the setup still valid? If yes, hold it. If not, then you need to think of exit it. The third scenario is the opposite of the first scenario, that the market will go to the opposite direction right away. There's no doubt you have to exit at the stop loss and take the loss. For the first and the third scenario, they are very straightforward and clear. You either take the profit or take the loss. But for the second scenario, when it is consolidating, you could panic. You don't know whether you want to hold the position or you want to exit the position. So to tell that, we want to see what the question you want to ask for yourself before you take any action. The basic question or the key question is, the setup is still valid or not? Then the next question is, how can you tell whether the setup is still valid? In this video, I'm going to show you how with an example. Now let's have a look at this chart. The market is following the trend lines here, and then it is going down. And then after a while, the market breaks the top trend line to the upside with three consecutive very strong bull bars here. So this is a range breakout. And then the market is very strong because take a look at the top of the breakout here. This point is higher than any of the previous major high here. 3 points here. And then if we draw a line at the top of the previous high here, we can see that this bull bar is breaking out the level. So that's why this breakout is very strong, which means the market is very strong. Then when do we enter the market? First, we want to wait for the pullback. And then we want to put our stop at the bottom of the first bull bar here, basically. That's the stop loss. Even though it is huge, but that's the initial stop. Even though it is not the actual stop loss. And then another thing is that given the market is very strong with these three strong bull bars here, we can do a measured move as the profit target. Remember the setup here. It is a range breakout. This is very important later on when we tell whether it is still a range breakout. Then the market pulls back here with a bear bar. And then another bull bar comes after the bear bar. So the pullback is over. And then after you see this bull bar, this is the signal bar, you want to enter the market. And then you can put your entry at the top of this bull bar, or even you can enter upon the close of this bull bar, depending on your strategy. Then let's have a look at what happened next. The next bar is a bear bar instead of a bull bar. But the top of this bear bar is higher than the top of this bull bar. That means if you put your trade on top of this bull bar, it's going to get triggered. Right now, you're in a position. But right after you are in a position, the market goes down. It doesn't go your way. So if you are a beginner, you could panic. The question you may ask yourself, why did I put a trigger? But that's not the real question. The real question is for you to ask is, does the setup still hold? Is the setup of the range breakout still valid? The key to answer the question is the understanding of the range breakout. Take a look at the big picture, starting at this point here. The market is going down, and then we can treat this as the first leg down, and then pulls back. And then it's possible that it goes down again to test this level. If that's the case, it's a bigger range, rather than a range breakout at a smaller scale. But at this moment, I would say the setup is still valid, because the market is still going to test the top trend line, and then it didn't reach it yet. So the answer is the setup is still valid. Then when the setup is not valid anymore, so when the market goes back into the range and so far or even reached the bottom here, that means the setup is not valid. That's why I said initial stop loss should be at the bottom of this first bull bar. You may wonder if I put my initial stop loss here and then I take a stop, then that means I lose a lot. But it's yes or no, because trading is based on probability. This setup normally gives 70-80% of a good trade. That's why most of the time you should be getting a good trade and then get profit. And then the market gives another bull bar. So this is a good sign because it's testing the top trend line, but it failed and then it bounced back. So right now, if you ask the question again, does the setup still hold? Yes, it's still valid. And then it is testing the top trend line. Like I said, if testing trend line and failed, that means the whole setup is still valid. And then at the point of time, you can also add up position because the market probably will go up. And then next, you can see the market has one bull bar and another bear bar. But take a look at the bear bar. The tail is very large, and that means the support, which means the upper pressure. So also at this moment, you ask yourself, does the setup still hold? The answer is yes, because it didn't go down even further and then it goes back up. And then it is testing the trend line again, but it failed. So you could add position as well. Then take a look at the next bar. It is a big bull bar. That means the market pullback is over and the market will take off to the upside. Then the next important question to ask is, how long should I wait for the consolidation? I cannot wait forever, right? So that's a good question. Let's have a look at the pullback. Here is a push down. Up, the second push down. Up, the third push down. So after the 3 pushes, the market takes off. So the 3 pushes is the criteria for you to tell whether the setup is still valid or how long you should wait. When you see 3 pushes and the market goes to your way, that's good. If not, then you need to exit the market. So remember these 3 pushes. If there's a one more push down, you want to get out of the market right away, because most of the time the market won't go up, so it will gonna form the range like a going down, up, and then down. It's not a range breakout anymore. But if you choose to wait for the market a little bit more, you can put your exit or stop loss at the bottom of the pullback here. This is what happened later on. The market did go up, but the thing is that you want to notice the market is weak already. It's weakened by the 3 pushes, because the longer the consolidation, the weaker the market will be. And then you want to scalp out, take 1 or 2 times of your risk rather than the measured move, because the market is not strong anymore. Let's do a measured move and see how the market goes. You measure from the bottom of the first bull bar breakout here to the top of the last breakout bull bar. So this is the distance the market goes. And then you measure from your stop loss here, basically the bottom of the stop loss to the top, the same distance. You can see the market didn't reach the measured move. So if you're waiting for the measured move, it's possible that you're not maximizing your profit. To sum up, after you enter a position and the market is consolidating, the key question for you to ask is whether the setup is still valid.